It's October 29th, 2012. Hurricane Sandy is tearing through the East Coast with 80-mile-per-hour winds. New York City is flooding. 8 million people have lost power. The stock market is closed for 2 straight days, something that hadn't happened since 1888. But while most businesses were counting their losses, one company was quietly making a fortune. Amazon's stock would surge 40% in the year following Sandy, adding over $20 billion to their market cap. How did a natural disaster that caused $65 billion in damage end up being one of the best things that ever happened to Jeff Bezos? The answer reveals everything about how modern commerce really works and why Amazon became the trillion-dollar giant it is today. When Hurricane Sandy made landfall, it didn't just knock out power lines, it knocked out an entire way of life. Suddenly, 60 million Americans along the East Coast couldn't do what they'd always done: hop in their car and drive to the store. Think about the numbers here. The average American household makes 1.5 shopping trips per week. Multiply that by 60 million people affected by Sandy, and you're looking at roughly 90 million shopping trips that simply couldn't happen during that first week alone. But here's where it gets interesting. Those people still needed stuff. They needed batteries, flashlights, non-perishable food, blankets, phone chargers, all the essentials you grab during an emergency. Traditional retail was paralyzed, but Amazon was just getting started. While stores like Target, Walmart, and Best Buy were dealing with flooded locations, power outages, and impassable roads, Amazon's fulfillment centers, strategically located inland, were humming along. Their network of warehouses in Pennsylvania, Delaware, and New Jersey were largely unaffected. More importantly, their delivery infrastructure was designed for exactly this kind of chaos. The company had spent the previous decade building what they called their logistics moat, a network so robust it could function even when traditional supply chains collapsed. And Sandy was about to prove just how valuable that moat really was. Here's where the real money started flowing. In the week following Hurricane Sandy, Amazon reported a 114% spike in emergency supply orders across the affected regions. But it wasn't just emergency supplies, it was everything. People who had never seriously shopped online before were suddenly creating Amazon accounts out of necessity. The data tells the story. Amazon gained 3.2 million new Prime members in the 3 months following Sandy. That might not sound like much today, but remember, this was 2012. Amazon only had about 10 million Prime members total at the time. Sandy had just increased their subscriber base by nearly a third, and each of those Prime members was worth serious money. Amazon's internal data showed that Prime members spent an average of $1,340 per year on the platform, compared to just $708 for regular customers. Do the math. 3.2 million new members times an extra $632 in annual spending equals over $2 billion in additional yearly revenue. But the real gold mine wasn't the immediate surge in orders. It was the behavioral shift that Sandy triggered. Studies by MIT researchers later showed that customers who were forced to shop online during emergencies were 23% more likely to continue shopping online afterward, even when normal retail options returned. Amazon had essentially gotten millions of people to try their drug for free, and now they were hooked. Now let's talk about why Amazon could capitalize on this chaos while others couldn't. It all comes down to infrastructure and the massive investments Amazon had made that seemed crazy at the time. By 2012, Amazon was spending $4.6 billion annually on fulfillment centers, technology, and logistics, nearly 13% of their total revenue. Wall Street analysts were constantly criticizing Jeff Bezos for these excessive infrastructure costs. Amazon's profit margins were razor-thin, sometimes non-existent, because Bezos kept pouring money into warehouses and delivery systems. But Sandy revealed the genius of this strategy. While traditional retailers were constrained by their physical locations, Amazon could route orders through their network of 40-plus fulfillment centers. If one region was hit by the storm, they could seamlessly shift operations to unaffected areas. The numbers during Sandy Week were staggering. Amazon processed 306 orders per second during peak hours, a 78% increase from normal volumes. Their logistics network handled 15.7 million packages in the week following the hurricane, compared to their usual 8.9 million. Most impressively, Amazon maintained their delivery promises. While FedEx and UPS struggled with disrupted routes, Amazon's own delivery network, which they'd been quietly building, kept running. They had partnerships with local couriers, backup delivery routes, and even experimented with same-day delivery using bicycle messengers in Manhattan. Before we dive into how this translated into massive profits, make sure you're subscribed and hit that notification bell. We break down the economics behind major business stories like this every week, and trust me, you don't want to miss what Amazon did next. Now let's follow the money, because the numbers from Sandy's aftermath are absolutely wild. Amazon's Q4 2012 earnings, which included the Sandy period, showed a 27% increase in North American sales compared to the previous year. But here's the kicker: their profit margins actually improved during this period, even though they were handling massive order volumes. How is that possible? Scale and efficiency. Amazon's fixed costs, their warehouses, their technology systems, their staff, were already in place. When order volume spiked by 114%, most of that additional revenue dropped straight to the bottom line. It's the same reason why software companies are so profitable. Once you build the system, serving more customers costs almost nothing extra. The financial impact extended far beyond just Q4. Amazon's stock price, which had been trading around $242 before Sandy, hit $398 by the end of 2013, a 64% increase. Meanwhile, traditional retailers were struggling. Target stock grew just 18% in the same period. Best Buy actually declined by 91%. But the really smart money was looking at Amazon's long-term positioning. Sandy had accelerated e-commerce adoption by an estimated 2 to 3 years. Trends that analysts predicted would happen gradually were now happening all at once. Amazon's market share in US e-commerce jumped from 15% in early 2012 to 22% by late 2013. In dollar terms, that's an additional $14.8 billion in market share captured in just 18 months. And in the retail game, market share is everything. It's incredibly expensive to win back customers once they've switched platforms. Sandy didn't just make Amazon richer, it fundamentally changed how Americans think about shopping, and Amazon was perfectly positioned to capture this shift. Before Sandy, online shopping was still considered a secondary option for most people. You bought books online, maybe some electronics, but for everything else, you went to physical stores. Sandy forced millions of people to discover that online shopping wasn't just convenient, it was often better. The economic data backs this up. US e-commerce sales grew 13.4% in 2013, compared to just 2.5% growth in traditional retail. But Amazon captured a disproportionate share of this growth because they had the infrastructure to handle it. Here's where Amazon's strategy gets really brilliant. They used their Sandy windfall to double down on infrastructure spending. In 2013, they increased their fulfillment and technology investments to $6.8 billion, a 48% increase from the previous year. This created what economists call a virtuous cycle. More infrastructure meant faster delivery times, which attracted more customers, which generated more revenue, which funded even more infrastructure improvements. By 2014, Amazon was offering same-day delivery in 14 major cities. Their Prime membership had grown to 50 million subscribers, 5 times what it was before Sandy. And their average delivery time had dropped from 5 to 7 days to 2 to 3 days for Prime members. Traditional retailers simply couldn't compete with this pace of improvement. Walmart, despite being 3 times larger than Amazon in total revenue, was spending only $2.4 billion on e-commerce infrastructure in 2014, less than half of Amazon's investment. Here's what makes the Sandy story so important. It showed that Amazon wasn't just an online bookstore that had gotten lucky. They had built a fundamentally different kind of business, one that got stronger during exactly the moments when traditional businesses got weaker. The financial numbers tell an incredible story. Amazon's revenue grew from $61 billion in 2012 to $107 billion in 2015, a 75% increase in just 3 years. But more importantly, they had shifted from being a low-margin, high-volume business to a high-margin, high-volume business. Their AWS cloud division, which provided the computing power for their e-commerce platform, became a standalone profit center worth billions. Their advertising business, built on the customer data they collected, generated $31 billion in revenue by 2020. But the most valuable thing Amazon gained from Sandy wasn't immediate revenue, it was behavioral data. They learned exactly how people shop during crises, what products they need, how much they're willing to pay, and how quickly they expect delivery. This data became incredibly valuable during the next major crisis, COVID-19. Amazon's response to the pandemic was essentially a scaled-up version of their Sandy playbook. They knew which products to stock, which regions to prioritize, and how to manage supply chain disruptions. The result? Amazon's market cap grew by $838 billion during 2020, more than the entire GDP of most countries. So here's the lesson from Hurricane Sandy and Amazon's incredible response. The companies that win aren't necessarily the ones with the best products or the lowest prices. They're the ones with the best systems. Amazon spent years building infrastructure that seemed expensive and unnecessary, until suddenly it wasn't. When crisis hit, they were the only company that could deliver what people needed, when they needed it. Sandy turned millions of Americans into Amazon customers overnight, but it was Amazon's decade of preparation that let them capitalize on that opportunity. They understood something that traditional retailers missed. In a connected world, logistics isn't just about moving products, it's about moving faster than your competition. Today, Amazon is worth over $1.5 trillion. They control nearly 40% of US e-commerce and have fundamentally changed how we shop, work, and live. And it all accelerated because of a hurricane that most people remember as a disaster. But for Jeff Bezos and Amazon shareholders, Hurricane Sandy wasn't a disaster at all. It was the best thing that ever happened to them. A natural experiment that proved their business model worked even under the most extreme conditions. The next time you see a company making massive infrastructure investments that seem to hurt their short-term profits, remember Amazon and Sandy. Sometimes the best time to plant a tree was 20 years ago, and the second best time is right now. What do you think? Was Amazon just lucky, or did they genuinely outsmart the entire retail industry? Let me know in the comments below, and don't forget to subscribe for more deep dives into the economics behind the biggest business stories of our time.